Start a show. Oops. I'm gonna try something new today. I'm gonna try plugging in my headset and see how the sound is. Let's try this out. I'm on battery, so that means that, and my phone I think is at like 45% battery, so we'll see how long the iPhone can last live streaming without being plugged in, and kind of go from there. Hopefully everyone's getting the notification. Hopefully I set up the settings right, and people are getting the notification. Today we're going to talk about levered stock investing. And it's something I've talked on the channel before about. It's something that I continue to touch on. And I think it's the most important under talked about topic in FIRE and in investing in general. A lot of people are afraid of debt, but if you wield debt like a weapon to sort of slay the financial or FIRE beast, it can be extremely powerful. And it's a powerful tool in your, set of your arsenal or your set of tools to play with, right? So I think that if you use it as a tool and you use it to do great things, it can be an awesome way to grow your wealth. So let's talk about how levered stock investing works. One, interactive brokers is a place to start. People are going to ask, hey, where do you go for, if you're in Canada, the United States, where do you go to do basic levered stock investing? We're going to talk about the advanced settings in a second here, because at interactive brokers, you can take a stock and you can, let's say $1 million stock portfolio, you can go borrow right now at about 1% interest, $500,000 and withdraw it right now. So if you have $1 million, you put it in your stock portfolio, you can pull out 500 grand right now and go buy real estate, go do whatever you want, take the 500 grand and reinvest it back into interactive brokers and buy stocks funded at 1%. So you go buy dividend stocks that pay a 7% return, let's say hypothetically, or an 8% return, and then it will cost you 1% cost of debt. And if you can do that at 50% leverage, then you'd basically be able to double your effective return. So instead of getting a 7% return, you might get a net of debt like 13% return. So that can juice up any basic stock portfolio with such a low cost of debt right now, with people being able to borrow from their stock portfolios at such low interest rates. It's extremely, extremely attractive. And by the way, as people get the notification, let me know if it's any better with a headset. I just got my earbuds in from my iPhone, and I don't know if the sound quality is going to be better or not. You guys tell me. It's just an experiment to see if it sounds better than the more, acoustic sound of the echo coming off of the walls behind me, right? So my thoughts are it's going to be a little bit better. But talking about the levered play, let's compare real estate. And then, by the way, part 2 of leverage is clearly taking what you have in your portfolio, bringing it to private banking. So going to TD, BMO, Scotiabank, CIBC, whatever, they all have private banking divisions. Every bank has a high net worth private banking area. And in private banking, you pay no bank fees, no NSF. If a check bounces, no NSF, no banking fees, nothing. You're a high priority client. You bring in a check for 50 grand, usually they don't even hold it. So there's a ton of perks that come along with private banking, including an unlimited number of bank accounts, in most cases free wires or very, very low cost wires. Lots of cool things in the private banking space. But within private banking, there's private banking lending and private banking investing. And so you can open investment accounts where you can buy, trade stock or whatever. And then there's an advanced level where we have an advisor who buys and sells stock for you. It's a bit more expensive. You're paying like a flat fee, typically, depending on how much you've invested, about 0.75% to 0.95%. So not quite a whole percentage point, but you lose that in a fee. But they manage your entire stock portfolio for you. And the cool thing in the private banking space is this stock portfolio is going to help you do lending on the other places you want to grow your business. You want to buy a business? Cool. You've got a huge stock portfolio with them. They're willing to take a look now at lending you on that business. Or you want to buy real estate and you didn't qualify before? Now you're going to qualify because they're going to look at your stock portfolio and say, wow, he's a high net worth individual. Let's approve him for a mortgage, even though he doesn't have the income potentially to service it, right? Or maybe we could take a look at the dividend portfolio and use that and qualify that for buying real estate or buying businesses. So it's part of your ecosystem, I think, as you level up, is to lever up. So as you level up, you want to lever up. And ideally, you do it cheaply and you do it safely. So you're only buying, like I'm not buying stuff I think it's gonna blow up in my face and I'm gonna have a margin call where I have to pay it back. I'm looking to buy stuff that's solid, blue chip, that I have, I want to own for the next 5 or 10 years, that has a solid dividend that's around 4 times the interest cost. So when my dividends are paying me, say, $1,000, my interest cost is $250. That way I'm profiting every month on either Interactive Brokers or the bank's money. And the bank will give you lines of credits. This is the cool stuff, against your portfolio at 70% loan to value. So if you put $1 million in theory, and you bought a portfolio of dividend producing stocks, and they'd lend you back at prime 70% loan to value. So you can put $1 million in and withdraw $700,000. So instead of taking $1 million and buying real estate, take $1 million, buy a nice, robust stock portfolio of dividend producing companies, and then borrow back at prime the $700,000 you've got. Basically, you take that $700,000, you could theoretically put it back in a stock portfolio. So you go from $1 million now to $1.7 million, so $1,700,000 in your stock portfolio, and your cost of debt is like prime interest rate, or if it's Interactive Brokers, they go 50% loan to value before they'll margin call you, and they'll lend around 1% interest rate. So super, super cheap, almost free money that you can go invest and make tons of money on the bank's money. That's what made real estate investing so attractive. When I started investing in real estate at 19, it was because I was like, hey, I can go put $1 up and the bank will put $4 and I can buy an asset. So I put $20,000 down, I can buy a $100,000 house because the bank puts up the $80,000 mortgage. When appreciation happens 3%, boom, I get 5-to-1 leverage on my money. My 3% appreciation becomes 15% on my invested capital. Now, when you can do this with a stock portfolio and it's zero effort, zero anything, it's super, super fantastic. It's one of those things where, let's say you were buying a company that pays an 8% dividend, just for quick math. And there are companies that have paid consistent dividends around 7-8%. A lot of the real estate companies, even like the real estate investment trusts, like REITs, are paying 7-8%. A lot of the utility companies out there, there are a lot of, you can go on the indexes and go look at the dogs of the Dow is a good place to look as a first screen. Now, a lot of the companies on there are terrible too, but I like dogs of the TSX, dogs of the Dow, dogs of the NASDAQ. If you're looking in certain indexes, to try to find the best yielding companies. That's a screen you can start with. And then go on there and look at those companies. Some of them are going to be beat up. And so price to dividend yield is going to be potentially because of an actual factor that makes you not want to invest. So maybe the company's going way down. And so their price has been plummeting, but their dividends remain consistent. And so their dividend yield's gone way up. Maybe they're paying a 8 or 9% dividend, but you're looking at it, hey, what's the free cash flow looking like? What's the forecast looking like? What's the underlying fundamentals of this company look like? Can they sustain that dividend for the next 5 years? Do they have the free cash flow? Or are they paying a dividend that's not sustainable? In which case, you maybe don't want to invest in that company, right? So history of dividends, and then ability with free cash flow to continue to pay those dividends going forward, right? But let's go back to this example to explain levered stock investing. In private banking, I'd probably buy a collection of companies. Realistically, I'd buy like 10 or 20 different companies, all that are paying that kind of dividend yield. So I might average 5 or 6% dividend yield plus any appreciation on the stock. But let's just assume that stocks aren't appreciating in value, which they are, especially as the government prints money and we go through inflation. As companies grow, they tend to their market caps increase and the value of their stock goes up. But let's just look at the dividends, because that's something you can count on. That's something that there are companies that have 50 years of consistent dividends every single quarter, going back for decades. And so it's pretty consistent. You can probably count on it. You can think of some big names in the S&P 500, big names on the Toronto Stock Exchange, big banks that are, I don't want to say too big to fail, but very, very unlikely to not pay a dividend. So you can pretty much count on it, right? So anyway, what was I saying? You get this collection of companies. Let's just pretend it's one aggregate company for now that I'm buying that has an 8% dividend, just for easy math. If it was an 8% dividend and I can borrow at prime, which right now is 2.45, I get a spread, let's call it 2.5. We'll just round up a little bit. I get a spread right there of, what do we get, 5.5% interest. That's pure profit on every dollar the bank lends me. So let's say I put $1 million in and I pull out 700K. I can go take that and buy real estate, do whatever. In an ideal world, we'll talk about margin calls in a second and how you mitigate that risk. A lot of people use their margin lines. They don't draw it all the way down. They keep it there so that during recessions, they can double down when the stocks that they like in their basket of stocks that they own, and when some of them are undervalued, they jump in with their 70% line of credit and they just go hard on those stocks they love. Like during COVID, a lot of people will take their lines of credits and double down. But the cool thing is this: you put $1 million in, you get $700,000 out. So you've only tied up $300,000 of your own money to own $1 million in shares. That's like buying a piece of real estate for $1 million and putting $300,000 down. In that way, it's very comparable buying real estate in Toronto and London, all the markets around me, stuff selling at a 6 cap, 7 cap maybe.
I can buy dividend stocks that produce at a 6 or 7 cap as well. So real estate, if you're buying at 30% down, and leveraged stock investing, if you're buying at 30% down, are the same. And real estate requires you to set up utilities in your name, to fight for financing, to go through all the crap to place a tenant, property management, the effort to eventually sell it. Whereas I click a button, sold. To sell a property takes a lot of energy and effort to prepare it for sale. There are a lot of things you have to do to manage a property. It requires effort. The tax implications of preparing a T776 for each property, and even just managing a manager, there's a lot of time investment. It doesn't scale easily. The stock portfolio scales easily, but looking at the two differences, interest cost about the same. After Interactive Brokers, actually, interest cost is less than most mortgages. So that's where it's like you can borrow against a stock portfolio cheaper than you could borrow against real estate. That wasn't a thing 10 years ago. Interactive Brokers didn't have the interest rate costs they do now. And on $1 million margin loan at Interactive Brokers against your stock portfolio, you're looking at like a 1% or like 1.1% average cost of debt. My mortgage portfolio right now has an average cost of debt of like 2.7%. So it's 2.5 times more expensive for me to borrow against real estate than it is to borrow against stocks. And in private banking world, I can go 70% loan to value. So and when I go to buy a property, I'm like 75% loan to value. If it's a commercial property, sometimes you're 65% loan to value. Like if you're buying a 10-plex or a 12-plex, in a lot of cases you're putting, or any commercial building that has any office space or anything that's not strictly residential, in a lot of cases you're putting more down than I am to buy stocks. So that's where it's like I'm looking at this whole masterpiece of all of the different asset classes, and I'm like, levered stock investing more attractive potentially than real estate because there's no time commitment, because you don't have to put all the energy in that you have to put in. Like I can go spend the energy of buying these properties and managing these properties and go and make a couple $100,000 potentially investing that time into some other business, right? That's where I'm like, when you adjust for time, real estate, assuming a sort of stable market, might not outperform the stock portfolio. And I think that regardless, even if you love real estate, you should still be doing some leveraged stock investing, because the banks are going to look and the lenders are going to look more favorably on your real estate portfolio if you go and apply for another mortgage or refinance or whatever, and you have a huge stock portfolio. They like to see that diversity. It's making my real estate investing journey easier, my refinancing easier. Everything is just better when I have this stock portfolio. So there's some huge advantages, I think. It doesn't make sense necessarily to, doesn't make sense necessarily to focus on one or the other, right? I think that's a balanced approach is key. Having a little bit of lending, having a little bit of a stock portfolio, having the real estate portfolio, and then owning some private businesses is key. Unless you've got some sort of competitive advantage, and I think in real estate it's very hard to develop a competitive advantage that doesn't require a lot of time input. So I guess it depends on where you're at in your journey, but it's very hard to make it completely systematized. Employees leave, systems fail, and you end up having to jump in and run your business. And it's a business at the end of the day, right? And I think that real estate underperforms as a business compared to other businesses that I've been looking at recently. But again, the risk in real estate is lower. It's a safer asset class, I think, than, well, maybe not right now. It might be a little bit overvalued, but that can be said of the stock market. That can be said of a lot of private business valuations right now too. So just be careful what you're buying and make sure you're doing your due diligence. But looking at that quick math, right? Like $1 million, if I had $1 million right now to allocate, I could go buy some properties, or I could instead invest in a stock portfolio, get $700,000 back in a line of credit, and then go buy some properties. So I could have $1 million in stocks and have potentially a couple $1 million in real estate, as opposed to just a couple $1 million in real estate. So I would take the capital, put it into the stock portfolio first, pull it out, and then buy the real estate. That's a better way to do it. It's kind of cool. You can actually take the line of credit money out of your stock portfolio and then buy more stocks and then get a line of credit on that as well. So it's like a never-ending cycle. You put $1 million in, get $700,000 line of credit, take $700,000 line of credit, put it back in. $700,000 line of credit would get you another $500,000 or $490,000 line of credit on that $700,000 you put back in. So you could essentially take $1 million and borrow a couple $1 million back by reinvesting it. Does that make sense? Are people following the math on that? So you had $1 million in theory. You could put in $1 million. You get $700,000 on your $1 million to pull out, put it back in a stock portfolio, get 70% loan to value on that new $700,000 that you put back into your stock portfolio. So now your line of credit's gone from $700,000 to almost $1.2 million. And so you have a $1.2 million line of credit now, and you can do it again and double down. So 70% each time what you put back in. And so the leverage can be really attractive, assuming you have the ability to cover Sorry, Gloria, to answer your question, I just saw it pop up. It's an easy one. At Interactive Brokers, you can go online and see their margin rates when they're lending against a stock portfolio. They go 50% loan to value, so not quite as high. If you're options trading, they'll go 3-to-1, so you get way more leverage options trading. So you can effectively just set up some call options and it'd be the same as holding stocks, but you'd be way more levered and you'd have way less or way more exposure to more shares. So that's an interesting way to do it in Interactive Brokers. But the cost of interest is about 1%. So it's prime minus 1.4 at Interactive Brokers. So you're borrowing to buy stocks at prime minus, cheaper than you're going to ever get on the best mortgages you're ever like. No one's getting a mortgage rate better than Interactive Brokers is providing right now. So it's just cheap, almost free money. Everyone should be taking advantage of that right now. If you got 50 grand, put it in Interactive Brokers, you get 25 grand line of credit with them right away. Now, as long as your stocks don't go down in value, you're holding solid blue chip dividend companies and you're ready to if they call you for margin, a margin call is this. The margin call is the idea that the stocks go down in value. Let's say they go down 10% in value. Your line of credit is negatively affected. The room in your line of credit is decreased. So you have to leave a little bit of room in your line of credit for market volatility or have some unsecured lines of credits that you have personally. Like I have unsecured lines of credits, one for $65,000 I never use. It's there in case I get a margin call. I personally have lines of credits at different banks. I can take that capital. I can put that in to cover any downside. But worst case scenario is they'll force the sale when the stocks are going down in value. So it's not really what you'd want, but worst case scenario, you could always buy back in and then ride the thing back up. It's not the end of the world. Of course, with a mortgage, at least they don't margin call you. So there is some advantage to investing in real estate. I will always have a real estate portfolio. I strongly do believe in real estate as an asset class. I just believe in diversification. Am I still live? Can you guys hear me? My timer has stopped, so I don't know if it's live or not right now. You guys gotta tell me. Someone jump in and tell me we're still live. I got a phone call and it came in as annoying. One of my mentees, he knows I'm live, so I don't know why he's just messing with me, or maybe he forgot I'm live. But Brandon, can you do me a favor? Can you text Jonas and tell him I'm live? I don't know why he's calling me right now, but he just canceled the stream, so just send him a text for me. Forgot my train of thought. So, and when you're borrowing in private banking and you're getting a little bit higher loan to value against your portfolio, once your portfolio is very large, you can go get rates in the market, which are below prime. But if your portfolio is smaller, I'm talking like under $5 million loan, under $5 million line of credit. So you're like not a super high net worth individual, I believe. I think that it's around prime interest rate is what you're going to get. Maybe prime plus a quarter if you're a less qualified individual. But as your net worth grows, the rates get better. So kind of where you're at, depending on your situation. But Interactive Brokers, they have a list of published rates right on their website. I think it starts at like, I want to say like 1.5% or something. It gets the average cost of the debt goes down the more that you borrow. So if they're dealing with like $1 million or $2 million in a margin line, they're going to be a lot better interest rate than if you're borrowing just a little bit, right? Which makes sense from their business perspective. But yeah, it was really attractive to go take $1 million and then own a couple $1 million in shares by levering up on what you already have, right? So you're just taking your money and you're reinvesting, and then you're reinvesting it again. You get a bigger line of credit, then you invest that line of credit back into the portfolio, and you get a bigger line of credit. So it's kind of cool how that works. If you're buying more stocks, and let's say you had $1 million line of credit, you had $700,000 or $500,000 Interactive Brokers margin line, then you put that $500,000 back into your share portfolio of different collection of different shares in different companies, then you're going to have 1.5 million in total value. And so now 500,000 is very small comparatively to the overall portfolio size. So anyway, back to the questions. There's some question and answer, and then we can dive a little deeper. But it's just something I really want to hit on. Like I know I used to break ground in 2018 talking about things that no one was talking about, and people started sharing my stuff around, and then it gets out there. And that's what I want. I want people to know about it. I want people to be sharing about it, and it's kind of a cool little thing. Maybe it's more of an advanced strategy, but I see people on here being like, and I see even like, what's the word? Influencers on different platforms saying like real estate is everything, forget stocks. And I'm like, that's just such a myopic viewpoint. It's just so narrow and limited, and it's not the belief that wealthy people have. And I've just been opening my mind up to some of these opportunities that I've been coming across. So yeah. Addie says, hi Mike, any tips on growing a TFSA? Growth stocks seem like the wrong option. Well, the thing with growth stocks is they're overvalued right now because, well, in my opinion, especially some of the tech play stuff, because there's just so much cheap free money in the market. Like when you can go borrow at 1% against your portfolio and go put that to work in businesses, what happens is people are grabbing large amounts of money and just throwing it at stupid stuff. Like, oh, I love, and I'm not going to throw Tesla under the bus, but like, I love a Tesla. I love the company. I love Elon Musk, whatever. I don't care about the cash flow. I don't care about this. I just to the moon, right? Or like GameStop, or like all these things that people are throwing money into, and it's just blowing stuff up irrationally. I think when we look at the actual financials with growth stocks, you're paying for what might happen. That's the scary thing. We don't know what's going to happen. Even the best analysts in the world have no idea what is going to happen in the future. They try to make forecasts and they try to estimate. But if you look at financial statements today, you can say, hey, today we know they're bringing in cash flow. But if you look at the financial statements and it's like these growth companies are like, hey, they're bleeding money. They make no profit. Revenue is still tiny, but in the future, they're going to make huge revenue. It's a very speculative play. So I think growth stocks, in my opinion, should be like 10 or 20% of your portfolio, a very small amount. It's there so in case things go to the moon in companies that you love, you can throw a little money aside at it. But I don't think it makes sense to throw all your money into growth stocks. I feel better about options trading and making calculated risks where you're getting paid premiums to sell options than I am to throw it all on red. You know what I mean? But that's just my style. Losing money is so painful. Psychologically speaking, people feel 2 to 3 times worse losing the same amount of money as they do gaining the money, right? So I think it's very, very important to remember that losses are very painful. And when, like, I had to work really hard for what I have. And so I'm not willing to throw it away on a high risk, whatever it is I'm investing in. So I believe in buying with my stock portfolio. Most of it is in solid blue chip stuff that'll be here for another 30, 50, 100 years. Solid companies that I know produce cash flow now, that sell things that everyone needs, that's just stable and safe. Real estate, the same thing. I like to buy properties that I can stabilize. I like to buy them needing work, but then I stabilize them. And I know I can get collected check every single month. I know what my mortgage payment is. I know there's cash flow every single month. I don't know if it's going to appreciate. I don't know if the government's going to print money. I don't know what immigration statistics are going to look like. We can guess. I can hope for the best. I can speculate on that stuff, and that's a bonus with real estate, but I don't bet on that when I'm buying, right? So that's where I kind of stay out of my stock portfolio too. I feel the same way, unless there's some sort of competitive advantage. Like if I knew something, like someone told me, hey, Tesla's got this new battery that no one else knows about, and it's coming out like in 2 months, that'd be insider trading. But like, let's just say I knew something and I understood the tech, and I was like, yeah, I know 2 friends are engineers there, and that tech is going to work. Market isn't sure about it, but I'm sure about it. Then I might jump into that, right? But a lot of people are just jumping in because they're like, hey, I like Starbucks. Like I like to drink my Starbucks. I like the Tesla. It's a cool car. I'm going to invest in it. And they don't understand the valuation. So it doesn't matter what the price is, they're going to buy it because they like the car. That's the wrong way to invest. I think that's the wrong way to invest to build long-term wealth. So yeah, going to keep going here. Rajesh says, hope all is well. What is the value in hiring a home inspector for a new build under Tarion home warranty? Is it better before closing, 30 days within closing, or within a year of closing? Well, Rajesh, I don't know if I've never hired a home inspector to look at a new build before. I do my own home inspections for the most part. I've hired a couple of them in the beginning just to understand what their checklists look like. Then I copied the checklist and did it myself and went through every item they looked for. And I did a more thorough inspection, and I didn't have any biases. It's for my own property. So I'm going in there with the lens of like, look for the worst. And so that's just been my perspective. But someone who doesn't understand, for sure, if you don't understand construction, the good thing about a new build is it was under building permit. So it's been inspected by the city. And the Ontario Building Code is and most national building codes are fairly strict. So not a lot passes through. I've seen some crazy stuff get passed before though. And so that's why you always want to, make sure that you're going and inspecting as they're building and taking a look at it. Maybe bring a contractor with you to give some feedback. You can pay a contractor 20 or 30 bucks for an hour to come look at it, and maybe even 50 bucks. And they could tell you exactly, like a good framing contractor can tell you all the framing stuff, whether it's done properly or not, although it's already being inspected by the city and it's under warranty. So if anything happens, Tarion warranty lasts 7 years. So in my own house, we had some issues with installation. We had some issues with a bunch of stuff that, my builder obviously got passed, but they came back and they were good about it and they repaired everything. So that's what's beautiful about the Tarion warranty is you pay for, if the builder doesn't come back and make it right, Tarion will come back and make it right. And so that's where you're kind of protected in that sense. But it depends on the builder you're using. Most builders, if you're using a solid builder, then you're not gonna have any issue. They've built lots of homes and they're reputable, etc. But there are some sketchy like builders who have done like 2 builds before. You might want to look after their stuff and make sure they're doing everything properly. But yeah, maybe there's value in it if you really don't understand construction at all. But I think that the tear-down warranty really makes things a lot safer for you. Yeah. Mike says, should you trade within the TFSA only or both in TFSA and a private fund? Well, my understanding is with TFSAs, only a few banks will secure against them. Now, you can go and take your TFSA portfolio and get an independent to go put a loan against it. But I think in Interactive Brokers, they don't margin on the TFSA. So it's harder to get the margin trading going on that. Correct me if I'm wrong. I have to double check on that, but I'm pretty sure they don't let you margin. There's certain things you can't do in your TFSA. There's certain option trades you can't make in your tax-free savings account or TFSA. I think that if you're going to be doing options trading, you should probably be doing it outside of your tax-free savings account, only because if you're a good options trader and you succeed, the CRA can always contest that and say, hey, that was an active business. You were doing that as a pro trader, and pro traders aren't protected in their TFSAs. They would, like, there's people who have invested in their tax-free savings account, turn it from 70,000 to 2 million, and the government's like, no, that's not tax-free. You're a professional trader. You've made too much in returns. We're going to tax that actually as active income for you. So that's been some of the rulings that I've heard from accountants, and I don't really study the case law, but that's something to be careful of, trading in your tax-free savings account. So I do my options trading outside of my tax-free savings account. And again, I have more options. Inside your tax-free savings account, you can't do any naked trading. So you can't, for instance, sell an option if you don't have the shares, or same thing with a call option. You have to actually have the shares, or at least have the room to buy the shares, I believe. If you have the cash available to buy the shares, they might let you. I'd have to double check on the rules on that. I don't trade in my TFSA, but I don't think you can do any naked trading inside of your, it has to be all covered, I think. Someone can jump in if they know better. I'm not an expert on that stuff. You have to Google that. But yeah. Off topic, but are you having a boy or a girl? A girl, Linda. Thank you for asking. 3 girls. Father of 3 any day now. No Name says margin call will put your initial investment at risk. Well, it depends on, exactly. So it depends on what you're investing in. And you obviously want to keep a little bit of room available just in case the market does dip, or have unsecured lines of credits or reserves in case there's an issue with margin. So I like Interactive Brokers over all of their platforms because Questrade, as an example, their margins at like 6% interest. Interactive Brokers is at like 1% interest. They charge 500-600% more. So anyone who trades professionally or wants to get a margin account set up, don't do it anywhere except for Interactive Brokers or in private banking where they can give you prime rates and if you're a high net worth individual. So yeah. Next one. Thinking of selling my 3-year-old house in Totemham. I have no idea where that is. Thinking of using purple bricks in this hot market, or would you recommend using a realtor instead? How would you screen a realtor? Again, I think that when you're looking to sell, you want to look at the conditions in your market. And so in a really hot market, as an example, if you list it with purple bricks, which is sort of like a DIY listing service, they got bought up by Comfree here in Ontario. But basically, you can list it yourself, or they give you discounted commissions to list and get your exposure on the MLS. I've found that it can make really, really good sense to find a good realtor in the right market. So where it's not, like in my market in London, Ontario, you put something on MLS, it'll sell. Like a realtor will you'll get so many offers if you price right and you have good pictures and you have a quality product, that having the realtor to list doesn't add that much value. But if the market's not as hot, if you got like a mediocre market, or like what is in London like a year ago, like even a decently hot market, the realtor can bring a lot of value. So they could potentially provide staging. They could help you, line up trades, or if you have a home inspection issue, they could help resolve that when that happens. They could help line up financing for a client. They could have a good list of clientele that wouldn't have otherwise been on the MLS looking, but they have money, and they're like, hey, whenever a realtor sends me something, I look at it. And so there's a lot of eyeballs that you might not have had on the property, depending on which realtor you're connecting with. So I would be interviewing the realtor to find out how many transactions they do in a year. What does their buyers list look like? Is it mom and pops that buy one time, or is their buyers list like all investors? Because then that depends on the type of property you're going to be selling, right? And what kind of transactions are they doing? Are they doing mostly, one-off single-family homes, or are they focused on multifamily? Do they understand if it's a multifamily property? And I don't know if it is. If it is, then you'd want to make sure they understand net operating income, cap rates, the commercial financing, commercial insurance. Do they understand all of that? That's essential. There's a lot of realtors who post stuff, and I get deals buying off these realtors because they don't know what they're doing. They post stuff not understanding cap rates, not understanding some of the intricacies of multifamily. And so, yeah, that's all part of the game. And you want to make sure you do due diligence. I'm sure there's lists online of questions you could ask your realtor. But make sure you look for one that's investor focused, I think, is a key for selling an investment property. Bark says, do you work a normal job or do you just live off your investments? So I don't work, no, I just live off my investments. Yep. DJ says, if you make a deposit on property and mortgage doesn't go through, what are some ways to save deposit and deal if you went firm? So when you've gone firm, right, you've removed your conditions on the offer, you stand to be sued for the difference of any damages they might have, any holding costs, and the difference between what they sell it to someone else for and what they sold it to you for. Your deposit is just the start. So if your deposit isn't large enough, they could sue you for the difference. But interestingly enough, I've gone through this and I had a deal that like 4 days before closing, they backed out. And it's one of those things where we had, I think in this case, a $10,000 deposit and they wouldn't release the deposit to us. They said, no, we're not going to release it. You can sue us for it. So we're stuck in limbo trying to get this deposit back and we have to fight for it just to get the deposit. So it's not as easy as you might think to get that deposit as the seller when someone walks away. And in a lot of cases, people walk away with a slap on the wrist. So you might get away with it, but there's always the risk they could keep your deposit. They're definitely not going to release the deposit back to you. It'll probably just stay in limbo. But they're definitely not going to release the deposit back to you. And it's one of those things we definitely want to keep on as far as if you're walking away, there's big risk there. So I wouldn't walk away from a deal. It's better to close the deal unless you're going to lose a lot of money on the deal or something. Find a way to finance it with a private lender, probably cheaper than taking that deposit loss and taking all the potential liability of being sued for not closing. That's why writing a firm offer, you need to make sure that you're actually able to close. Financing falls through sometimes. You have to go to a B lender or an alternate lender and pay a high interest rate. Maybe you got to just sell the property after, but it's better than being that person who walks away. Also, that person that walks away now has a bad reputation. Your realtor is never going to trust your offer again, and that seller might talk about you as the person that walked away on the deal. So now good luck trying to find another house. So something to think about when you walk away on an offer. I think it's very disrespectful. It's something I've never had to do. So I've made almost 100 offers now and closed on every single deal. I've had to assign deals sometimes. I've had to go for crazy financing, but I've always been able to close on everything that I've offered. And my word is my bond, and that's something that I take very seriously, that I respect to the utmost severity walking away in a deal. So I think walking away is terrible, and there's a lot of liability risk with it as well. They could sue you, and you could have to pay all their mortgage costs, their holding costs, lose your deposit, and then some. Right? So there's a risk for sure. It could be cheaper, most likely is cheaper to find alternative financing. Addie says, how high does your net worth have to be to access private banking? It depends on the private bank, but somewhere in the range of, I think, 1.5 million on the very, very lowest, to some banks don't start till 3.5, 4 million for some of the more premium stuff. And then the really cool features, I think, like the really cheap interest rates and stuff, start when you're well over 10 million in investable assets that they can verify, is my understanding. And I don't know, every bank has different rules. You have to talk to your private banking people and find out. Hi, Mike. What strategy are you taking for your options trading, and are you using TFSA? So no, I don't. I think the TFSA is best maximized using something like a third-party Olympia Trust Corp, where you can basically lend out of your tax-free savings account in private mortgages. So private mortgages, you can make 28%, 29% legally and be within the limits and grow your tax-free savings account really, really quick, and it's guaranteed and safe. Options trading is risky. You can lose money theoretically, right? Even if you're just selling, let's say you're just selling puts and that's all you do, you might be assigned the shares. They might put the shares in your account. That's the worst case scenario, is you get the shares at a slight cost-based discount because you get to keep the insurance premium on the sale, right? So there's, yeah. And I forget the other part of the question here. Let me see. What platform? Interactive brokers, I think was the other part of that question. I lost the spot where I was at now. But the strategy I use is I like to sell options. That's my preference. I like to be the insurance guy as opposed to buying them. And I would also be interested in the spread trading as well, because you can limit your downside. Gloria says, I answered that question already. Sorry, Gloria. James says, Would you take advantage of the Canada dividend benefits with this? Yes. So if you built a dividend portfolio, dividends are tax preferred. You can check out my video on that. It's one of my favorite strategies, is that a couple in Canada can each collect $50,000, a little bit more than $50,000 now, in tax-free dividend income. So, and then by the way, you can deduct that interest off of your investment capital gain as well. So it can be very tax preferred to make 100 grand a year plus whatever's in your tax-free savings account. You can make potentially 120 grand a year, almost 10 grand a month in early retirement and pay no tax if you're investing in Canadian companies with Canadian eligible dividends. That's huge. And with leverage, you could build a portfolio like $1 million could get you a couple $1 million in stocks. So you might only have $1 million and you're retiring on that, but your $1 million gets you $100,000 a year in dividend income because you're levering it up and then splitting it between both spouses. So that's something you can do here in Canada. It's pretty sweet. Canada is actually a haven for early retirees who are lean fire. For Lux Fire, like if you're in more the higher income bracket, it's death. Like I'm getting destroyed on taxes. I need to get my income down. The problem with that is I'd have to stop doing anything. And I like doing too much. Business opportunities fall in my lap and I can't help it. So that's my problem. I probably should end up in a tax haven like Costa Rica or Puerto Rico, but it's really hard to relocate when you have family ties here. And I'd have to do an exit return and sell all my Canadian real estate portfolios in my personal name. It'll all have to come out of my personal name to stop filing a tax return here. So there's the cost to leave Canada is millions of dollars for me to sell my properties. The capital gains tax I'd have a 7-figure bill to leave Canada. So people say, hey, I'll just leave to Costa Rica, leave to Puerto Rico. That's great if you've got an internet business and no assets here. But for me, like I pay a ton in tax to file an exit return. It would be, I have to do over many years and strategically plan it out. So there's the more I research, the more I realize how complicated it is to leave. And like they could creep up the tax rate on us and it would take me years before I could afford to leave. And so it's like, do you just pay an extra $100,000 in tax when Trudeau raises your tax rate, or do you pay a 7-figure bill to leave? And so they kind of got you screwed either way. Welcome to Canada. But if you're a lean fire and you make less than $100,000 a year in Canadian eligible dividends, completely tax-free, free healthcare, tons of benefits. Check out my videos on that. Canada's an amazing place if you can keep your expenses low and your income low. Caesar says, should I total refinance my first house completely and then purchase a second home with 5% or 20%? Which area of London looks good to invest today? Which area of Ontario looks best? There are a lot of small towns in Ontario that could make sense to invest in that have good cap rates. I personally like Toronto. I like London. I like the major metropolitan. I don't like Windsor. I have never liked Windsor. It's a faraway city. It's so far from everything else, like by itself. And in Canada, it's like a 3.5-hour drive. And Windsor's always been a blue-collar, terrible town. Traditionally had bad fundamentals. I don't know how much it's changed. I hear it's getting better. But I think the values now are high. I went to Windsor actually in 2018 and looked at some properties, and it actually made sense. The valuations were slightly underpriced. Now everything's overvalued, I think, my personal opinion in a city like Windsor. And I even think places like Chatham are getting overvalued. And there's pockets in Sarnia too, now where I'm from, where I think it's overvalued. Pockets in London now where it's getting crazy. At least the market fundamentals in Toronto, in London, and some of the major like Ottawa, some of those major cities is good. Like they have a diverse economy with lots of different employers, and they're getting a lot of immigration. A lot of people want to move there. Who wants to move to Windsor? If you're new to Canada, you never even heard of Windsor. Maybe you've heard of Toronto. Maybe you've heard of Western University or Ivy or Fanshawe, the largest college. Like that might draw you to London. Toronto is obviously a mecca. Ottawa is the capital. Like in Ontario, there are places that get drawn in. But like somewhere like Sudbury. Like who's wanting to move to Sudbury? You can go mine there. Like what if mining becomes cost prohibitive or something changes in the industry? It's like those investments are dead. That's high risk to me, right? And so the cash flow doesn't make me feel safe enough to want to invest in a market like that. But people are doing it. They're having great success. And who knows what can happen, right? Like you can invest it all in Litecoin that go to the moon. So, anything can happen. You gotta manage your risk to reward and try to say, hey, what risk is worth it for you? Next question. Listening to an audiobook called The History of Central Banking and the Enslavement of Mankind by Stephen Mitford. It appears the central bankers instigate wars and enslave populations via usury and interest. I mean, you're not wrong. Humans are terrible. Like just in general, governments are very corrupt. People at the top tend to be very self-serving, sometimes under the guise of being philanthropical. Is that the right word? Philanthropical. I don't know. The word's eluding me. You know what the word I'm trying to say. It's I don't know. The word, I can't think of the word right now, but I think it's philanthropical. Yeah. So how does this work? The government, the central banks can it's in their best interest, of course, to create inflation. It's very good. They're supposed to monitor that, but it's actually in their best interest to create inflation and keep interest rates low. The lower the interest rates, the better the government can make their debt obligations. So it keeps things low. And then if you owe someone debt and you want to keep your interest payments low, you'd force interest rates down. If hyperinflation happens, who cares? Your debt just gets devalued. The government has no incentive to want to manage inflation, because think about this. The central bank, if they can create an inflationary environment, like in the housing, people talk about, if you go look at the consumer price index, you look at inflation, the official stats are like 1% inflation, 2% inflation, depending on which country you're in. But if you're in most developed nations, it's like sub 3%, pretty safe, like 1% to 2%. And so you're looking at the housing prices. Rents are up in the last 4 years, 30%. Housing prices in Ontario and in most of areas in West Canada, and there's most of Ontario is up about 60, 70%. And some pockets are up 120% over a 5-year period. Like what? The average person's budget is 40 to 50% spent on housing alone. The majority of the economy is driven by housing. I'm talking about renovations and all the people associated with the transaction of real estate, the lawyers and accountants and realtors and contractors and home inspectors and appraisers and whatever. There's a million different industries that are all, like, a huge portion of the Canadian GDP is tied to real estate. And real estate has gone way up in value, right? It's not affordable. When you double the price of housing and then say inflation's 2%, like, what does the actual index look like when rents are up 30%? They're like, oh, but Granny's renting her apartment for 15 years and her rent's still the same. There's rent control, 2% a year. So average rents have not gone up that much. And it's like, go try renting a place right now and compare that to 5 years ago. I can tell you for a fact, one bedrooms here in London, Ontario are double. I used to rent 2012, 2013, 2014. I posted a lot of listings. I could rent a one bedroom around that time for $595, all inclusive. Right now I can rent that same one bedroom apartment for $1,200, like all day long. Rent has doubled in a 5-year period. If that's half of everyone's budget and people are on fixed income, I guess minimum wage has gone up about 30% over this time, right? We had a huge minimum wage increase a couple of years back. In 2017, 2018, they phased it in. And that drove rents up a lot. Created, in my opinion, we actually had a lot of inflation. In the last 4 or 5 years, we've had a ton of inflation. The buying power of the dollar for the average person's budget goes a lot less far than it did. It just doesn't go as far. You used to be able to rent for $1,500 a month. You could rent a really nice house in London, Ontario, in pretty much anywhere in ever except like the major metropolitan of Toronto. But in the GTA, 5 years ago, I was finding people who rented for $1,595. These nice big houses for $1,595 plus utilities in the GTA suburbs that were worth $600,000. They're now worth probably $1.5 million for the same house. But you could rent for people renting houses out because they had old small mortgages. They're renting them out at cost, and so there was this arbitrage market in the rental space where your money could go pretty far. Your money doesn't go very far now. Housing is half of everyone's budget, right? And so I don't know where they're getting this 2% inflation from. The average person is struggling to get by right now. Even if you make 50, 100 grand a year, if you made 100 grand a year 5 years ago and you make 100 grand a year now, you can't live near as well. Like, if you make 100 grand a year right now, good luck buying an average house in London, Ontario, let alone like a slightly above average house. Like, my house here is over $1 million and I bought it a year and a half ago for $665,000. I did some renovations on it, made it nicer, but my house is not even like, there are a lot of nicer houses in London. I don't have a mansion or anything. Like, a mansion now used to be $1 million, got you a mansion in London. Now it's like 3-4 million. To qualify for that, your income needed to have gone up 300-400%. To get the same house and the same lifestyle, you need like triple the income that you needed 5 years ago. People aren't making triple what they made before. You can look at the Stats Canada data. So I think cost of living, because they adjust the consumer price index, they adjust the items they put TVs in there, technology, and technology's gotten a lot more affordable, right? TV's like $300 for a TV, used to be $1,000. So some stuff's gotten cheaper, right? But housing is your largest expense. So they should adjust the inflation index to what the average person is spending. Like the average person is spending like half their living costs on their home. So anyway, that's just my rant about buying power being decreased significantly. Luckily, I had a lot of assets, and so I rode with the tides when real estate went up in value. I was extremely levered. I had lots of mortgage money, lots of bank money. So my down payments, if stuff appreciates 10%, I have a mortgage 4-to-1, so I make 40% return, right? So it's, for me, I'm happy with it, but it's just a shitty situation for anyone on fixed income, that's for sure. Next question. What is your opinion of banks which lend out at near zero interest rate, where banks are owned by their host countries instead of private institutions which don't have the people's best interest at heart? Yeah, I mean, the thing is, it's up to the central bank what the prime rates are going to be, right? So the private institutions are only lending at a basically trying to make a spread on whatever the current central bank interest rates at. So they don't really have a choice, right? Like the government's selling bonds, right? They're trying to raise money, and the bank just buys them, right? And it's all a factor of what the central bank decides. And so, regardless of whether you like that private banks might not have your best interest at heart, they live on the spread, right? So let's say they have to pay 1% interest rate to attract capital in their savings accounts, and because prime is at whatever. And then let's say they're lending it out at 2%. They have to live on that 1% spread in between, plus maybe some fees for applications. That's a tight spread to live in. So in this low interest rate environment, it's very tight for the banks to make a good profit. They have to focus on, I think, their fee base as opposed to the spread on the interest product. So that's something that I just think in general is a challenge for banks right now. But if you want to invest, like banks are going to be here long term. They're backed by the government, especially in Canada here. They sort of have like what would you call it? Not a duopoly, but like there's 5 major banks, and so that's it, right? There's some credit unions that try, but really it's a closed group, and they'd be bailed out. So I feel comfortable investing in those financial institutions. I go buy shares because I know that they're bringing consistent income in. They got lots of debt that's still expiring at like 4% interest, et cetera, so forth. And they're able to, as the government prints money, they have a ton of money to go lend out and make a spread on. Banking is a great profitable industry. Lending is a very profitable industry. So if I like that industry and you're worried about having the best interest at heart, become a shareholder, own a piece of the bank. But yeah, I guess you have a point where banks are owned by their host country, then you'd have to trust in the government. And I have zero trust in the government. I have no trust in the bureaucracy of someone else putting my best interests ahead of their own. I just don't believe that's a thing in the political sphere, unfortunately. And the people who have the money have the influence and the power, and they can basically get done whatever they want. That's pretty much proven time and time again. So they don't really serve the people. They need 51% of the people to agree to back them. And so that can be bought. Like the large corporations and the wealthy individuals can buy those votes very easily. I think it'd be really smart if they rolled out a universal basic income of $2,000 a month. They're already beta testing it with the CERB, the COVID benefit, right? They're basically testing universal basic income, but bottom half of Canadians don't make net, like the average person under 40, that segment of people, they're currently making less than $2,000 a month net of all deductions. So $2,000 a month is like the same as what they're making now, but for no work. You could buy their vote. Like the government can just literally give out UBI and they could buy the vote of the people, right? And so a conservative party that would come in and say, hey, we're more conservative. We don't think it's right to tax people a ton, to give a bunch of money away to all these stupid programs. Yeah, I don't know. We'll see. I don't want to get into too much politics here. My battery's going to die soon. So, how would you handle not getting a margin call if stocks drop significantly? What if the bank freezes your line of credit? Is that a legitimate concern? I mean, it's possible that you got a margin call and they will lower your line of credit. They will ask for a recall. More likely than not, what they'll do is they'll sell your position until they get to a point where they've repaid enough. So that's basically how it will work. They'll force a sale on the stock. But if you instead had unsecured lines of credits or some available capital sitting aside that you could top up, you'd be good to go, right? So maybe some unsecured lines of credits that are too risky or too high interest to touch. They're at like maybe 6 or 7% interest, but it's there in case you get a call. Okay, I got 4 banks, 50,000 a piece, 200 grand here to put towards my margin call if something happens. I recommend everyone do that. Go to all the banks and get an unsecured line of credit before you lose your job. That's something you should always do if you're looking to retire early. Do that before. James Anderson says Canadian stocks or more diversified. Unfortunately, you have to invest through Canadian funds to get the maximum loan to value percentage. So I'm heavily weighted in Canada, but I buy Canadian funds that then buy US funds. It's weird how that works, but if you buy stuff on the Toronto Stock Exchange that's actually focused on other markets, that's how you get your exposure while getting maximum loan to value. But it depends. Like Interactive Brokers, I think it's 50% regardless if it's Canadian or US, I think. What's causing the 5-year bond rate to go up? Do you predict? So Jonas's question, why not get the camera on your laptop? It's just more work to set on my laptop, and the camera's worse. The quality's worse. It just doesn't go as well. There's more of a lag. So on the phone has the best quality, other than, I guess, setting up my camera, but then we were having technical difficulties where it would shut off. So this is the most consistent, stable stream it has been using my phone, strangely enough. Raz says, what's causing the 5-year bond rate to go up? Do you predict it will be going back down in the near future, i.e. more stimulus? Well, it all comes down to the market valuing risk at the end of the day. How long do they believe that interest rates will stay low? How strong do they believe the economy is? And they is the consensus of everyone. I guess like all the investors getting together and deciding, in the market, we feel, interest rates are going to go up or whatever. And so they'll try to price all that in, right? So there'll be a premium on the bond yields depending. I gotta go. My phone's gonna die soon. I gotta get through a lot of these questions really, really quick. I'm gonna try to do no long questions, just quick ones. If I have 40,000 in an account right now at Interactive Brokers, how do I unlock more options trading? Stock Hacker Academy. James, if you have 40,000 in your account, you should be able to margin trade. So you should be able to buy like $100,000 in options. I wouldn't use all your available room, because then you get called on your option. You're screwed if they force a sale on a bad day. I would prefer to maybe go, if you had 40,000, you could buy $80,000 probably in options fairly easily. I think if you have a pro account in Interactive Brokers, you should automatically see that there within your margin account. Maybe because it's in your tax-free savings account, they're not giving you leverage. I don't know. Snake Eyes says, what argument would you make to someone to get them to refinance their paid off $1 million home? Well, the argument's easy. If you have $1 million home, you could go get an $800,000 mortgage. $800,000 could go then put in a stock portfolio, and then you could borrow on the $800,000. You could borrow back 70% loan to value on that, which is another $560,000 line of credit back at prime interest rate. So you could effectively have, if they just took their house and put a mortgage on it, they could create a $800,000 stock portfolio and still have another $560,000. Let's say you don't use all of it, use $500,000 of it to go buy some more real estate. And the net cash flow from their dividend portfolio, their stock portfolio and dividends, and their real estate they just bought is going to be way larger than the interest cost on their mortgage. And so they're way ahead. That $800,000 could potentially produce 10, 20%, 30% return on their money. At 10%, that's $80,000 a year. So by paying off their house, they're foregoing $80,000 a year in potential income. So the interest cost at 2% right now on $800,000 is $16,000 a year. So 80,000 minus 16,000 equals the net that they're losing by paying off their house. So I think paying off your house is ridiculously dumb. You have to be extremely conservative and believe that you can't get better than a 3% return in the market. And if you believe that, then pay off your house. If you believe you can get more than 3% return annual, you should lever up. Are you familiar with the Smith maneuver? Yes, I am familiar. Smith maneuver. So with the Smith maneuver, you get a line of credit on your house. The HELOCs don't get called. It doesn't work that way. They get an appraisal, and the bank doesn't. They just don't do that. They don't call on. They theoretically could call if there's a big crash in real estate. I've never seen it done. I've never seen them recall a mortgage, but in theory it could. If they had it drawn down, I doubt they would do anything. But on the stock side, yes, they will do margin calls. But on the real estate side, no, they don't do calls. Questrade has something, especially if you make your payments on time. Questrade has something called margin power, so you can leverage the funds in your TFSA. Questrade interest rates are like 7% though. Yeah, sucky. I don't know if Interactive Brokers has something similar maybe you can access to. They must, I would think. Brandon says, long equity call options, long equity put options, short equity call options with a fully covered position, covered call, long equity put positions with a fully covered position, protective put. So basically you can put, if you have the shares, so you're covered, then you can trade options on it, is roughly what he just said there. But you're very limited in what you can do with inside your tax-free savings account. Naveen says, at what point do you need to start liquidating stocks if you're looking into getting a mortgage? I've been trying to raise capital for real estate by using the stock market. I'm trying to understand your point. ideally you'd raise it from other sources, not from your stock portfolio, but you could take your stock portfolio and get a margin loan on it at Interactive Brokers. If you had $1 million in the stock portfolio, you get $500,000 at 1 point something percent right now to go buy real estate. So yeah, check out the video. If you watched the beginning, you can learn all about that. Hi, I'm using my mom's account. I'm 15 and graduating in a few months. I'm watching. Whoa, 15 and graduating in a few months. That's super impressive. I'm watching these videos before I graduate because I'm doing money management instead of pointless math. Again, smart things. I think the math, the trigonometry and calculus that I studied in grade 12, and I think I took vectors and calculus in grade 12, served me zero. Like I literally just wasted, oops, phone's gonna die soon. Sorry guys. I literally just wasted hundreds of hours of my time just to get a good grade, just to get into the top business program because I thought it would get me a better job, because I thought it would get me better opportunities in life. I don't know if that's true. There's something to be said about getting into a good college and, you know, building a resume and stuff. So I suffered through it. But yeah, was it useful in my life? No. Glad to see you on here. Do you have any of your videos you would suggest for me to watch? I have hundreds of live streams at an hour a piece. So I have a couple hundred hours of live content over the last 3 years. But I've got lots of good videos you could check out on basic understanding of real estate, personal finance. Go through my early playlist and look for some of the good thumbnails, whatever interests you, and watch it. I'd love to hear about the TFSA lending Olympia mortgage strategy. Yeah, we should talk more about that. It's pretty cool. You can take the money in your tax-free savings account, put it into a tax-free savings account at Olympia Trust, and then lend it out to, you know, find a friend or find someone in a networking group who has a property that they don't want to sell for a long time, and you can put a second mortgage on it or a third mortgage on it, and they can just pay you interest, and it's perfect. You can grow your tax-free savings account really quick. Yeah, maybe you could do each other's, something like that, or a three-way triangle or something. You find some people who all want to do it, and you guys all lend on each other's property or something. I think it has to be arm's length, so look into the rules on that, but maybe there's some sort of TFSA lending triangle people do. I don't know. There's probably companies too that will take your tax-free savings account and borrow it. So you can look into those people too. And lots of investors that I know that look for that. So just find one of those people who want to borrow it. Ash says, does it still make sense to buy a condo in downtown Toronto? I think now it makes more sense than it did a year ago or 2 years ago because condo prices are beat up with COVID. There's just not as much interest or traction for that. Best long stocks. I like blue chip stuff that's like a utility play that has a high dividend. I like anything that you don't have a choice in. So as an example, like your hydro, your gas, and we're like the consumer has to buy it from Enbridge as an example, or they have to buy it from London Hydro, or they have to buy like toilet paper or whatever, stuff like that, right? Like I like solid stuff that's consistent and stable. That's just my preference when I'm building a base portfolio, and then I take a percentage of my portfolio and I put it into the higher risk plays. I meant, what if you get a margin call because of 50 or 70% crash and all the banks freeze all your lines of credits? I mean, yeah, that's possible. It could happen. In which case you would have to sell off stock at a loss, and that would suck until they got to a point where they were feeling they were within the margin rule, within the margin limits, right? They'll lend 90% to 100% on cash. So you've got to think that on a stock portfolio, if you're lending 70%, as soon as you start liquidating your positions. And hopefully, like I have a portfolio manager, he'll start liquidating the positions that make the most sense from a tax perspective, until we would just have a discussion about what we would do, right? Like I would use all my unsecured lines of credits, all my available liquidity to try to cover the call. Worst case scenario, we'd have to sell some of the positions off. Darn, right? I'd still have a good sized portfolio. I might have to sell 10% of my stock portfolio off to cover the margin call, right? So just be prepared that can happen. If that happened, I would immediately start trading on the options side on those positions to cover my cost base on that forced sale. Maybe, for instance, I would go a long call on it immediately, and I would still have the right to buy those shares later. I would protect any movement back up. You can protect yourself from margin calls on your portfolio. So that's the best way I would do it with my Interactive Brokers account. Anyway, thank y'all so much for watching. It's been a great hour. I really appreciate y'all tuning in. For all the people watching the replay, smash that like button. If you're watching live, smash the like button. Jump in the comments and say hi. It's always just nice to say, hey, I watched the stream for 2 minutes, thanks. Or I watched the whole stream, cool. All that stuff matters to me, and it helps the engagement. Yeah, so stay tuned, guys. I got more content coming your way every week, live from 7 to 8 p.m. approximately every single Wednesday Eastern Standard Time. The secret to unlocking a wealthier you is 3 levers. Personal finance is dead simple. You got to spend less, earn more, and maximize returns on the difference. Thanks, everyone. Have a good week. I'll see you next week. And on Instagram, live at Mike Rosehart. Give me a follow. I'm doing stories 6 to 8 times a day, and I'm very accessible on the Instagram platform. Thanks, everyone. Talk to you next week.